Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at RCAT Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Correct.
We are diving into a very specific opportunity here. It's high growth, definitely high volatility, and it's anchored firmly in the defense tech space.
Specifically drones, right?
Exactly. Autonomous drone systems. So, this isn't some generalized tech play. It is almost entirely dependent on what you could call the U.S. defense supercycle.
Okay, let's unpack this immediately then.
Yeah.
The fundamental story has to start with revenue. I mean, if we're talking about a high volatility, money-losing company.
Which it is.
Right. Then the only thing that justifies that kind of risk is just hypergrowth. So just how much growth are we actually talking about here? What's the trajectory look like?
What's fascinating here is the sheer velocity of it all, the ramp up. This isn't just, steady growth. It's a full-on explosion, and it's driven by defense contracts.
Okay, so give me the numbers.
RCAT reported Q3 2025 revenue growth of a staggering 646% year over year.
646%. That's a number you usually only see in, like, the biotech sector after a key FDA approval.
Exactly. And sequentially, just from Q2 to Q3, that was a 200% jump.
Wow.
But the story gets even more aggressive when we look at their guidance. The company is projecting Q4 revenue growth. Well, it's guided to an astronomical 1,455% year over year.
1,300%.
Yep. So for the full fiscal year 2025, they're projecting total revenue growth at about 124% year over year. They are scaling operations faster than almost anyone in the defense space right now.
That kind of growth it's astronomical. And frankly, it could be a red flag. I have to ask, is that ramp sustainable? Or is this just a one-time contract spike that's, impossible to replicate?
That's the key question.
Because explosive growth almost always sacrifices profitability, especially when you're trying to scale production that fast. Are they generating any free cash flow, or are they just burning cash to keep up?
And that's the critical tension here. If we connect this to the bigger picture, you're absolutely right. Margins are definitely pressured by all those scaling costs.
I'd imagine.
They reported an earnings per share miss in Q3 2025, which, that contributed to the stock volatility. And the projected EPS for the full fiscal year is still negative at minus 0.5.
So no free cash flow yet?
Not yet. They are burning cash, but I would argue they're doing it with purpose.
Okay, walk us through that purpose.
Well, the financial counterpoint is that they have a strong cash position.
Yeah.
And very low debt. So they're strategically reinvesting every dollar they can into growth.
Into what, specifically?
Specifically, they're doubling their production space to fulfill all these incoming orders. This is a very deliberate high-burn strategy. It's focused on capturing market share right now, while the defense drone market is still consolidating.
Not on rewarding shareholders.
No buybacks, no dividends. Management is clearly signaling that the time to grow is now.
Okay, but that intense growth only matters if they can keep it. So let's pivot to the competitive angle. Defense contracts are fiercely contested. What is their strategic moat? What ensures they capture this U.S. government spending?
The key is compliance and specialization. This is what makes the defense drone market so different from, say, the consumer market.
How so?
Their moat is built on regulatory hurdles that are basically designed to exclude non-U.S. competitors.
Even China.
Primarily, yeah. Their products, specifically their FPV drones like the Black Widow and the FNG, are NDAA compliant and U.S. made.
Okay, for listeners who might not be familiar with the jargon, what does that NDAA compliance actually mean in practice?
It's the National Defense Authorization Act, and for a manufacturer, it is a golden ticket. It legally mandates the exclusion of components, software, systems, anything manufactured in certain foreign adversarial countries.
So it gives U.S. manufacturers like RCAT a protected market.
A critical protected market advantage. And these FPV drones, that's first-person view, they're cheap, they're rapidly deployed, often expendable assets.
Like guided missiles almost.
Essentially, yeah. For immediate short-range reconnaissance or kinetic strikes. The U.S. military is moving away from these huge, expensive legacy systems towards smaller, attritable assets. That's the supercycle RCAT is writing.
That specialization is crucial then.
It is. That compliance ensures they qualify for these huge U.S. Army programs like the Short-Range Reconnaissance or SRR, Tranche 2.
And that's a big contract opportunity.
It's a major multi-vendor contract. If they secure a big piece of that, it validates their whole growth thesis. And on top of that, they're undergoing assessment for the Blue UAS cybersecurity certification.
What's that?
Think of Blue UAS as the cyber gatekeeper for the Department of Defense. You don't get through the door without it.
Okay, so this is where it gets really interesting for me. The sentiment, this kind of high-risk, high-reward story. It usually attracts retail speculators. But are the large institutional investors actually buying into this defense narrative?
You'd be surprised. Institutional conviction is remarkably high for a company of this size and volatility. Total ownership is sitting at nearly 38%.
38%.
And we've seen significant cluster buying from some very serious players. This isn't passive accumulation, it's aggressive, targeted buying.
Can you give us some specific examples? Who's buying?
Absolutely. So we saw AWM Investment raise its stake by 15.3%. Geode Capital, a really significant player, increased its holdings by an enormous 142.7%.
142%.
Yeah, that brought their total value up to over $12 million. And then there's XTX Topco, which spiked its stake by over 510%.
500%. They're essentially backing a truck full of cash up to RCAT's door.
That's one way to put it. These funds clearly believe that the current execution risk is manageable, and the long-term defense trend justifies this kind of aggressive accumulation.
That institutional confidence is really compelling, but it forces us to ask the obvious question. If growth is at 1,455% and institutions are piling in, why is the stock trading around $8? It's down from a 52-week high of over 16.
Right.
So for a new buyer, how should you view this dip after that Q3 earnings miss?
You're touching on the volatility that's just inherent in this space. Price action analysts are calling this dip, especially near that $6 to $7 support zone, a sell-off gift.
A buying opportunity.
A buying opportunity ahead of what they see as a potential Q4 validation. But we have to acknowledge the technical reality. This is a high-risk stock. It has a 13.47% volatility and a high beta of 1.64.
Okay, tell us why that beta of 1.64 really matters to the average investor.
So beta measures a stock's volatility relative to the whole market. A beta of 1.64 means that if the defense sector or even broader tech market moves up by 1%.
RCAT tends to move up by 1.64%.
Exactly. In a bull market or during a strong sector rotation, that just amplifies the potential upside. But the reverse is also true. If the market tanks, the losses are also amplified.
A double-edged sword.
For sure. But right now, technical signals are showing some constructive potential, suggesting maybe an accumulation phase ahead of those key catalysts we talked about.
Okay, that level of risk means we have to really understand the bear case. What are the biggest hurdles here? We mentioned the EPS miss, but what are the operational risks that the new leadership, the new COO and CFO, what do they have to overcome to justify this?
This raises probably the most important question for the bull thesis. The primary risk is simply execution delay.
They can't deliver on the promises.
Right. That guidance of 1,455% growth is incredibly aggressive. If they hit a supply chain bottleneck or face difficulties scaling U.S. production fast enough, it could lead to guidance shortfalls.
Just like what we saw in Q3 that caused the stock to dip.
Precisely. So the risk isn't necessarily a lack of demand, it's the operational machinery behind the demand.
And what about other risks?
The secondary risks are, one, the potential for dilution. That always looms when a growth company operates at a loss and needs capital. And two, continued pressure from insider selling. That's a big point of caution.
Why is that?
Well, if insiders are exiting despite a 1,455% guidance, that could signal a lack of confidence in their ability to deliver in the short term.
So how does the new leadership address these very real risks?
The whole bull case relies on this new management team driving operational efficiencies. The recent appointments of a new COO and CFO are intended to do just that, to professionalize and stabilize this massive operational ramp-up. They need to prove they can turn contracts into delivered products and eventually cash flow.
So the market is betting on this leadership pivot being the solution.
Entirely.
Okay, let's look at the calendar. What specific events in the next, say, 3 months will validate this turnaround story? What will either confirm the bull case or maybe cement the bear case?
We have 3 near-term, very high-impact milestones you need to watch. First, the Q4 FY 2025 earnings results. They're imminent.
This is the big one.
It's the big one. This confirms or denies if that absolutely enormous 1,455% year-over-year growth guidance actually materializes. If they hit that number, the stock is going to react probably violently upward.
And what about the strategic contracts you mentioned?
That's the second milestone. We're looking for updates on the SRR Tranche 2 program Any definitive contract announcement or status update here would confirm their ability to capture that protected U.S. defense market share.
And the third catalyst?
Definitive progress on the Blue UAS certification status. This is less about immediate revenue and more about long-term eligibility. Securing that certification just opens up so many more government procurement channels.
And all this is happening with a macro tailwind.
Exactly. The factor of continuously rising U.S. defense spending just acts as this powerful continuous tailwind for the entire sector.
So let's wrap this up. What does this all mean for someone considering this stock? It's a strong defense tech play. It's capitalizing on this U.S. drone supercycle with huge, almost unbelievable revenue growth projected.
Right.
And it seems analysts believe that while the risks are real, especially on the execution side, they're currently priced in, with the consensus suggesting high double-digit upside if, and it's a big if the SRR contracts materialize and that Q4 guidance is met.
And what's really fascinating here is that the whole thesis is about the pivot. It's a pivot away from being a high-growth startup to becoming a sustainable defense supplier. The leadership changes, the huge manufacturing ramps, they're all intended to pivot the company from its current losses toward profitability, which analysts project could happen by 2026.
So that's the inflection point to watch.
Keep your eye glued to that inflection point. Moving from massive reinvestment to positive free cash flow is the ultimate goal of their current strategy. And that's when this stock transforms from a speculation into a major player.
That's it for today's analysis. If you enjoyed this conversation and want to keep track of these developing stories in the defense technology space, make sure you hit that subscribe button.